Good afternoon, everyone, and welcome to today's session. Before I kind of hand over and get the session started, just do a quick introduction. Many of you probably will know who I am by now if you attend any of our previous sessions. I'm Manveen, I'm the Learning and Development Manager here at the MGA. I'd like to welcome you to this optics session hosted by AXA. Just a few housekeeping points before I hand over as well. So we are recording the session. You will notice that your camera and microphone are disabled at the moment. That's just to ensure that the presenters have the full bandwidth and minimise any disruption to the session. So please don't panic. We will enable mics and cameras for the Q&A so you can fully engage with us. On the topic of questions, we do welcome questions and we encourage you to ask. Feel free to pop them into the chat during the session. We will cover them in a Q&A dedicated space at the end. So please don't feel like you're going to miss your chance to speak with our presenters. We'll also have a short feedback survey link that we'll share at the end. So please do, if you can take some time to complete the feedback, it should take no longer than 2 minutes. Just continues to allow us to see that we deliver the best content to you. And then finally, our sessions are accredited by the CII for their content and quality. So if you feel it meets your learning needs, you can add it to your CPD log. Without further ado, that leads me to introduce today's session and hand over to our presenters, Sam and Lee. Thank you, everyone.
Wonderful. Thank you very much, Manveen, and thank you for the opportunity. So good afternoon, everybody. My name is Sam Holden. I'm Head of Distribution for AXA Delegated Authority Partnerships. And thank you very much for all joining us today. It's great to see a really strong turnout. Still got people joining, actually, for what I know will be a really insightful session. So today's topic, as you will have undoubtedly already seen, emerging products. And where can DAs and MGAs win? I would say it's both quite timely and increasingly important at the moment. We are no doubt all feeling the pace of change in the current market. New sectors are maturing, existing sectors are evolving, and customer expectations are shifting faster than many traditional products can keep up with. As such, the role of delegated authorities and MGAs has never been more important. The ability to move quickly, specialise deeply, and innovate around niche and underserved markets is creating opportunities that didn't exist maybe 5 or even 2 years ago. So what we're going to explore today is not only what's new, but where are the real and tangible areas of opportunity? Where can specialist underwriting and agile product development and distribution expertise truly differentiate and therefore win? We're going to be touching on emerging sectors, evolving risk landscapes, types of product features and solutions that are gaining traction at the moment, whether that's in technology-enabled industries, sustainability-linked products, or new liability and casualty environments that are still forming around us as I speak. So I don't want to steal any more thunder than I already have from today's main speaker. So I'd like to introduce Lee Hudson, our Head of Specialty. Many of you may already know Lee. He's been involved, and dare I say, at the forefront of specialty product development for many years, working closely with not only our kind of market partners, but other industry specialists to help build products that not only respond to today's risks and needs, but also, crucially, anticipate tomorrow's. Lee's going to take us through a presentation which will cover what we mean by specialty in the commercial market. As depending on who you speak to, it can be quite an ambiguous term. The types of value that products can offer, specific types of products that are available in the market today. Now, that won't be an exhaustive list because the number of specialty products is as wide as anybody's imagination, frankly. But also then we're going to cover off what we as a capacity provider tend to look for in a specialty partner or opportunity. Lee's session will probably run for about 30 minutes or so, which should then give us 10 or 15 minutes for Q&A, probably towards the end. If you can keep the questions ideally coming through via the chat, I will then kind of collate those, and we will pose those to Lee at the end. Or alternatively, if you particularly want to pop your microphone and camera on towards the end and raise any questions to Lee or myself, then that will be available to you as well. So again, thank you very much for joining us, and without further ado, Lee, over to you.
Thanks very much, Sam, and yeah, thanks everyone for spending this time with us over the lunch. Very much appreciate it. Hopefully you get something of value from it. So yeah, let's get into the presentation, shall we? We've got some slides to share. There's some learning objectives. There's a page of those. So next slide, please. So hopefully we will achieve these objectives. Bit of a challenge for me, but you know, that's something that we can hopefully deliver for everyone. I'm sure you saw those when they came through. But let's start with the big question. Next slide. What is specialty? So I'm going to start on the controversial topic here. Some people will very much disagree with me. I get asked all the time, oh, what about these specialty insurances you do, Lee? And I don't like that word speciality. It reminds me of cakes and, you know, kind of a food hall. As you can see with the picture here, there's too many eyes in it. So specialty, please. Specialty that I do, and that is the recognized kind of product in the insurance world. Let's try and stick with the right terminology and not use this specialty thing, but hopefully that's not too controversial for everyone. But what is specialty? So next slide. There we go. So it's kind of everything else. So it's not motor, mainstream motor products. You know, that is wheels. We don't do wheels in specialty particularly. Maybe sometimes you get some odd things come out of that area, like, you know, racing type risks. So there can be specialty products aligned with motor, but generally it's not motor. We've got some buildings there that are flooded, so there's a big claim for someone, isn't there? But it doesn't tend to be property risks. So there can be products that work around the whole property world. So you know, it can be things like latent defects can be specialty, which is obviously a property related product, but generally mainstream property is not what specialty is. We don't cover those kind of triggers, which is an important point. So you know, we have different reasons for paying claims that do not align to mainstream property, so it can be a good diversifier away from cat type exposures. Below the flooded town there, we do have someone who's got themselves in a bit of a pickle. This picture is meant to represent liability, you know, injury, casualty, if you like. Again, you know, there can be specialty products aligned to casualties high risks, particularly when in the kind of legal exposures world, and perhaps we'll talk about a few of those as we get into more detail. But you know, on the whole, again, it's not what specialty is. It's not mainstream liability. It's kind of everything else that sits around it, and there are some particular things that we can characterize it as. But if we think that, you know, it's not the mainstream property, not the mainstream liability, not motor, then think about everything else it could be. It could be, you know, all the different other products like financial lines and all sorts. So next slide, please, Manveen. So this is meant to represent that it's a bit more bespoke, that things are made to measure. And I think the thing to think of here is property, motor, casualty. These are things that pretty much every customer needs. So, you know, from a broking perspective, you're always going to be selling these products, so they're kind of very mainstream. Whereas specialty tends to be bespoke, but only of use to particular customers. So we may have a product that is a bonds product, but you know, if you're not in the area that the bond relates to, it's not a product you're going to buy. So the customer base, when it comes to specialty products, it isn't everyone. You've got to find particular niches of customers that are interested in the product. So it doesn't tend to be one size fits all. it tends to be, you can't talk about the product to everybody. It's got to be specific customers that have a proper need for the product, and that kind of needs assessment is very important, because obviously as an industry we're very obsessed with not mis-selling and making sure that our products are fit for purpose for every customer that buys them. Next slide, please. I'd also say that there can be different reasons here, and this may seem a bit odd that people buy insurance for non-insurance reasons. So, it's not about the indemnity sometimes when it comes to specialty products. Quite often they'll be buying because, the simple reason is that their customer won't give them the contract unless they bought the product. PI is a very obvious example on that one. Professional indemnity insurance, most professionals will tell you they're perfect and they never make mistakes. Why should they buy a policy that covers them for being negligent? That almost seems like an admittance that they're not very good at what they do. The reality is that they purchase the product either because their trade association insists on it, otherwise they can't trade, or perhaps their customers under contract are insisting that they have professional indemnity insurance, so they've got that backup in case something does go wrong, goes awry. So quite often the reasons why our customers are looking to buy these products, why they're spending money on them, tends to be away from the actual exposure case, tends to be they're being asked to do so by a third party for some reason or another. A great example is AXA travel bonds. That's a specialty product which every travel agent purchases, but they can't actually benefit from it themselves because the bond will only perform if they were to go bust. They buy it for the protection of their customers, and also the AXA, the trade body, insists that everybody buys that protection. So it's an enabler to trade rather than really being bought because they're concerned about the exposure that they have. Really, it's a hurdle to be overcome so they can do business. It's not something that they're purchasing because they want to get the benefit of the claims service. In fact, in many ways, they would be in quite a problem if they did need that help. That would be their business is failing and doing very, very poorly. So we have to think sometimes differently about the reasons why our customers are buying. And when those purchase decisions or those motivations for those purchasing decisions are different, we have to tailor our sales technique to those differing reasons for why they buy. Next slide, please. And so I mentioned it a little bit there that sometimes there are different reasons to buy, and sometimes that can be because the actual insured is not the beneficiary of the policy. Many specialty products will have a third party who actually benefits from the product being bought. I think that's easy to see from travel bonds. I'll give another example of latent defects insurance. For those of you that don't know, that's a product that is bought by developers to cover any unforeseen defects that come out of the property way into the future. It could be 10 years down the line. I'm sure many of you have heard of NHBC. They are a latent defects insurance provider, and many of you, when you've bought a property, brand new property, will then get that 10-year guarantee. That is a latent defects product, that 10-year guarantee that your new property won't have any latent defects found in it. But you're not paying any money for that product directly. That is being paid for by the developer, probably passing on quite a lot of the cost to the contractor. And they are buying that policy to no benefit from themselves, but they have to do it. It is the law that they provide a 10-year guarantee on any new residential property that they build. And so that then goes to the individual house purchaser as an insurance product or a bond that enables them to have that coverage in case those defects become apparent in their product, in their property. The reason why I've got a queue of people here is because actually you might not get just one beneficiary. If you think about a latent defects product being sold on an apartment building, there could be hundreds of apartments that have that latent defect, and therefore hundreds of apartment owners that are actually making the claim. So the beneficiaries of the policy can be a third party, and they can be multiple parties. Certainly with the apartments example I gave, you can imagine there's been quite a lot of latent defects claims coming out of cladding. So, you know, the whole cladding risk would be that every property owner in a apartment building has some sort of loss that needs covering collectively between them. So yeah, you can get quite a lot of claims coming from the situation. And, you know, another example, to go back to the travel bonds one, a travel agent will sell holidays to lots and lots of people. They'll collect deposits that need repaying from many, many future holiday makers. And so, yes, you get multiple claimants coming against the single policy, not just the insured looking for their own indemnity. Okay, I think I've mentioned that point. So let's have a look at some specific areas. Next slide, please. So I mentioned that you can get property and construction related ones, and I've described latent defects insurance there. So you can see, you know, I have picked out some apartment towers there, some nice ones with lots and lots of apartments in. And a latent defects policy is a very good example of a specialty product. It tends to be, you know, bought per construction. So it is not an annual policy at all. It tends to have to last for a very long period of time. The law says that cover has to be in place for residential purchases of new properties for 10 years. And in fact, if it's social housing, so where a housing association is building a property, it has to be 12 years. So you need an insurance company that's able to cope with those very, very long periods of policy periods. Latent defects, it's you know, you collect a premium up front and then you sit on the policy for a very long time. Takes quite a long time to write that. So quite specialist. Yeah, non-renewable as well. So a lot of specialty products are non-renewable. You place the policy and then the policy will last for the period. Another construction-related type product that we see increasingly is insurance-backed guarantees. So this is similar to latent defects. So if you're the developer, you'll buy the latent defects policy, but of course, you've got lots of people responsible for various parts of the construction that you're subcontracting work to. The main contractor will subcontract the windows, the roofs, the damp proofing, you might get some basement experts in, electricians, all sorts. So there can be many, many people involved, and they will look to contractually subcontract the risk of the latent defects product onto those individual contractors involved in the construction. All of those contractors will be expected to guarantee their work. But what happens if they are not around to come and fix any problems that they are responsible for? That's where the insurance backing of the guarantee comes in. So latent defects products will often insist that subcontractors involved in the contract buy a latent defect, buy their own version of latent defects, if you like, almost like a back-to-back, and that's called an insurance-backed guarantee. So the insurance-backed guarantee will be something that all the people in the construction process are expected to contribute to buy, which will then back up the latent defects products. And quite often, latent defects insurers will look to subrogate against those insurance-backed guarantees, those IBGs. And so eventually the party responsible for the defect of the property will be found, and will have to buy, you know, and the cover will kick in. You know, maybe there is actually a design fault. So again, the latent defects policy could subrogate against the architect's professional indemnity insurance or the surveyor's professional indemnity insurance. So PI can be a product involved in these scenarios as well. But that's more of a conventional renewable product, of course, although it is claims made, which makes it a little bit different. Another area in the whole construction space where you can see an increase in the number of specialty products around is performance bonds. So performance bonds, sometimes called construction bonds in the UK, the contractor will be expected to buy a performance bond. It's basically a promise to complete the construction. So if the contractor during the construction phase goes bust, what does the developer do? They need to find a new contractor, probably to finish the construction. They need to pay them. They've probably lost money in the money that they've given. So performance bonds is is a large area of exposure and can have quite big claims, and they can accumulate. Because if you can imagine, a contractor is going to buy a performance bond for multiple projects that they're involved in. And if they go bust, every single one of those bonds is going to be called on. So insurers have to be very careful about the accumulation risk from contractors going bust if they're offering performance bonds to particularly the large contractors who've got many contracts undergo at any one time. Again, they are based around the project rather than being annual, although some smaller contractors can buy an annual policy. But generally they tend to be construction or project based, and therefore not renewable again. So the quirks that you find in specialty business, all sorts of unusual kind of scenarios have developed over the years, and each particular nuance has its own little own little kind of history and the reasons why things are done in different ways. And there's always a lot to understand. It's quite nuanced, and there's all sorts of different things to try and get your head around in each space that you go into, which keeps it all interesting. From an underwriter's perspective, every day is a school day, and you're always learning about different things in the whole specialty space, which is certainly something that I enjoy. Okay, let's move on from property and construction. Can we have the forward slide, please? There we go. So here's some liability related ones, and particularly legal liability. So I've already mentioned travel bonds, so AXA and the various other trade bodies in that space. Now there's an increasing number. AXA are under threat actually from different organisations getting involved. So travel bonds is certainly something that is a very interesting specialty type product. It is based around insolvency of the travel agent, and it is about recompensing people who have paid deposits for holidays in the future. And interestingly, it's around recompensing people for any losses they may suffer due to the insolvency of the travel bond whilst they are on holiday. I'm sure you can all remember numerous examples. Probably the most famous one is Thomas Cook. When Thomas Cook went bust, there were lots of people stuck abroad who had no way of getting home. They had no flights. So AXA arranged for special planes to be put on to bring holidaymakers home from their Thomas Cook holidays. Big news at the time. Now, AXA paid for all of that from the bond, from the travel bond that Thomas Cook had to put in place. So that's what that product does. It's not just paying back people's deposits and contributions towards their holiday. It is also can include things like repatriation or paying for the remainder of the holiday at the hotel or whatever needs to be done, basically. And AXA manage those claims. So it's a bond that has little involvement from a claims perspective from an insurer, apart from writing the check. You pay the bond over, AXA will administer the actual notification and look after all the customers. And when they have completed doing so, if there's any amount left, you get that back, which is, it's nice to happen, but it doesn't necessarily always happen. Financial failure is written there, and financial failure is very similar to travel bonds. It's an insurance product that operates in the same kind of way. So it is insurance which will pay back people who rely on a business if it were to go bust. Investors, for anybody who you can sell a financial failure product to an insurance to a travel agent, or a non-AXA bonded one, I should say, and that would operate in very much the same way. So it helps third parties who are relying on a business in case it were to go bust. So we spend a lot of time looking into the quality of the business. As an underwriter, you're very interested in their cash flow, their profitability. Looking at reporting accounts, you get very used to looking through the reporting accounts from businesses and understanding what their balance sheets are telling you. Are they at risk of failure? Do they have lots of money? Can they meet their liabilities in the short and long term? There's a lot of work goes into that when you look at financial failure insurance. Decommissioning bonds is an interesting one. That was been put on here. So it's something we've very recently done at AXA. So it's very front of mind at the moment for me because it's something that's very new. But how to explain it? So if let's say I'm a developer and I've got the idea to build a solar farm. And I go to the bank and say, lend me lots of money so that I can build my solar farm, and I'll pay you back over a long period of time from the money that I'm making from, harvesting the sun and turning that into energy. And that's fine in itself. But quite often the developer of the solar farm will be on a third party's site. They'll be on a farm, for example. That's quite common in the UK. And the farmer will be lending them some fields. The farmer's going to be looking at that and thinking, oh, that's a reasonable investment. But what happens at the end of the 25-year lease? And I need all these panels removing. So they ask the developer to put some money aside for doing that. And they say, it's probably going to cost £1 million to decommission this site. You need to put that money aside, otherwise I'm not letting you build this on my farm. The developer's not that keen on tying up £1 million for 25 years. That doesn't seem like a great idea. They will probably save money from the money they're making from the project over time, so that at the end of the period they've got that £1 million ready to actually decommission the site. But they're not very keen on doing it from day one because they're not actually making any money and they're already borrowing a lot from the bank. So what do? They come to an insurance company and they ask for a decommissioning bond. And so that we say, we put our £1 million up from day one. That amount reduces over time as they make the profits from the project as they expected. And then at the end of the project, the developer has got his cash, the policy finishes, it's no longer needed. But that decommissioning bond is an efficient way for people to manage the cash flow. Rather than tying up that £1 million from day one, they buy the bond from us so that we will come up with the cash. And then they reduce it over time as they save up to pay for that decommissioning. Hopefully that makes sense. It's not an easy product to describe. And again, it's very much a project-based product. It's something that is long term. You can imagine the policy periods involved are very, very long. And it can involve what seems like big sums of money. And actually, when I mentioned the point about it not being of much use to the business, if the developer were to need that bond during the policy period, that means their project has failed in some way. That means they've probably gone bust. It means that there's quite a lot gone very badly wrong for them before they need that product. The beneficiary of that product is the farmer. He gets his site cleared, gets all those panels taken away, and it doesn't cost him anything. So our insured, the developer, really doesn't want to have to use this policy. It'd be bad news for them if they had to use it. Whereas it is something that they need to put it in place. Otherwise, the farmer's not going to agree to them, setting up the solar farm on their site. Hopefully that makes sense. You can see how it's a hurdle to being able to do business. It's something they have to buy, but do not want to use. They do not want to benefit from it. It's financially enabling for them, but it's not the product that they want to have to use. We will get claims, of course we will. But it won't be of benefit to the people buying the policy. It will be of benefit to third parties. In the decommissioning bonds example, it'll be beneficial to the landowner. And it's not just solar farms. That is a product that we see using in all sorts of energy generating ways, certainly wind farms, but that whole kind of green energy area is one that is very it needs those decommissioning bonds to work, because they do have that long period investment required, and so that is something that AXA is very keen to try and do from the perspective of enabling the green energy industry and trying to help UK develop in that space. So we're really very keen on that new product, quite a new space, quite a new thing to be doing. Insolvency bonds is mentioned below that, and that is, decommissioning bonds could be argued to be an insolvency bond, but the trigger there is insolvency. So there's all sorts of bond products around the insolvency of a business, and again, not much use to the business that's gone bust, that's gone insolvent, but of use to their customers, and therefore quite a lot of contracts would insist that a bond is put in place for particular circumstances, for particular reasons, and we can back those bonds with our, with AXA's deep pockets, just as other insurers can too. Much, very helpful for those businesses. Defective title. Now, defective title is a bit different, but still legal liability related. Many of you perhaps have bought a defective title policy when you've purchased a house, but never realised it. So this is a product that if when a solicitor does a search for a conveyance, for example, they may find particular bits and pieces that they're not sure about. It may be that there's possibly a dispute about a boundary. It may be that potentially there are charges due to the local church. It could be all sorts of reasons where the solicitor thinks that the title of the project of the property isn't perfect. And rather than try and fix that, what they will say is, hey, what you need to do to be able to complete this conveyance is just buy an insurance policy. When it comes to residential things, from what most of us doing via house, it's probably only going to be a couple of £100. I'm sure some of you have experienced that, where your solicitor has said, hey, you just need to buy this product and then we can tick this box and you can move on with your conveyance. It's usually quite a stressful time. You probably think it's only a couple of £100. I know personally I've been in the situation, you just say, yeah, I'll have it, thanks very much, let's get this done. So defective title policies can be very small like that, but they can also be quite large. Some of you may have heard of rights of light. So rights of light is where tall towers in central London, they are casting shadows, and that is affecting their customers, and they may have a legal liability for doing so, for stealing the light of their neighbours around them. And they can buy a defective title policy, a rights of light policy that will cover them if they were claimed, if someone sued them in such circumstances. That you can imagine that is a product that started in America and in places like New York City, but we're increasingly seeing it in the UK. So you can go from something which is very small, just a couple of £100, to a rights of light policy for a new tower in the City of London. That can cost hundreds of thousands of pounds. So defective title is a whole world of product there related to the potential of being sued for something to do with the title that you have over your land, over your property. Really kind of interesting space. Those products are in perpetuity. Now, a lot of insurance people struggle with this. The policy period, that means, is forever. That is a bit of a step back. People kind of go, hey, hang on. But no, seriously, defective title insurance policies have an inception date and no expiry date. They're alive forever. So that's quite a difficult one to explain to the actuaries sometimes. Quite good fun. Another legal liability one, after the event insurance. I'm sure many of you have got involved in ATE over the years, or have had it requested or needed it even. So that is a policy where the problem's already happened, but they're looking for insurance to do with the legal process. The way the law works in the UK is that the loser pays. That is the principle. In America, interestingly, it isn't. It's the opposite. Everybody pays their own costs. Doesn't matter who wins. But in the UK, the loser pays the costs. So if someone is suing you and they've spent £1 million doing so, and they are successful, you take on that £1 million legal bill. And that is very much what after the event insurance is about. So for people who want to be claims funders, and that's an increasing area of the UK economy, where they are funding it, they want to ensure the downside of losing that particular case in the courts, which is having to pay the other side's costs. So they can buy after the event insurance. There's already a claim. That's why it's after the event. But it's the potential of losing the case and having to pay costs that they want to insure against. If they win, no claim. If they lose, then the insurer will pay those additional costs that the court awards because your side has lost. So they're hedging that exposure. So lots of legal liability related things, very interesting kind of areas. And I think, there's all sorts of different nuances there and things to get involved in, all of it very interesting. Can we have the next slide, please? Financial lines. So, financial lines is quite established when it comes to specialty products. We've all dealt with PI policies. I've mentioned them already. Then med mal policies are increasing as we see more private healthcare in the UK. Intellectual property can be part of a PI policy, but increasingly we're seeing standalone policies that don't just protect you if you infringe a third party's intellectual property, but also will pay for you to pursue somebody infringing your intellectual property. So that's almost like a legal expenses additional cover there. So IP policies are at the moment pretty much very much in the creative space, but we do see them increasingly, and I think that is an area that is going to grow, and we're going to see IP policies be bought more readily. They can also be part of a management liability policy. D&O used to be, when I started my career hundreds of years ago, not every business bought it, believe it or not. Now, of course, management liability is purchased by everybody, really. I think we'll go on the same journey with cyber. Cyber at the moment is still a bit niche. It can mean many, many different things to different people, but actually most businesses have this exposure, and I think we're going to see cyber become a very mainstream product, and I can see it being more increasingly embedded in packages, like management liability can be now, like legal expenses can be, and just be a staple part of what people buy when they're looking for their insurance purchase. I appreciate that at the beginning I said that it's not one size fits all. It can be very specific, but sometimes some specialty products do cross that line and they do become something that everybody buy. Management liability is a good example. I think cyber will be one that it becomes something that every business has to buy. PI isn't. Why not? Because not everybody has that kind of duty of care that a professional has. So, that's a good example where it is bespoke. PI is specifically for professionals and needs to stay that way. Thank you. That's financial lines. Can I have the next one? So, as well as all that, I thought I'd mention, there is a whole world of specialty out there. Hence all the different flavors of sweets there. A very representative slide. So there's all sorts of areas where there are tons and tons of different specialty things. And I maybe had a specialty, but I would not claim to be expert in most of these, let alone all of them. There's just too much to know, too much different things to be looking at. There are areas that are really interesting, A&H, credit. I think those are really interesting ones for the UK. And there's the whole entertainment space is something that people particularly enjoy as well, because there's always usually some interesting gossip that you don't know unless you're in that space. Political risk is an increasing one and very relevant right now, of course, because we're seeing the damage to the economy, where everybody's worried about the damage that we're going to see to the economy because of Mr. Trump's little gallivant in Iran. Should we call it that? But yeah, political risk is definitely something that is an interesting space, and some of these are wider than just the UK. Some of them are very international, and certainly some of the things on this list I stole from AXA XL. So thank you for that, friends at AXA XL. There are certainly things that they're interested in doing. Many of the ones here. I'm happy to answer questions on those, although, as I say, I wouldn't claim to be an expert on all of them. Can we have the next slide? Okay, so specialty partners. What do we look for in a specialty partner? I think this is, having explained all that and the whole wide world of specialty there, I think it's really, key to talk about what do we look for when we talk to, the people that want to use our capacity to go out into whatever specialty place that they're interested in. And I think that, as a capacity provider here, I'm actually looking for people who know a lot more about their space than I know. They're very, very much the experts, very, very much of a track record in the space, can, say they're going to use the capacity that we have to deploy well. I think that the successful MGAs in the specialty space, are able to do that. They don't just kind of turn up and go, oh, I fancy doing this today. Actually, they've got real specialist expertise in the area that they're looking at, and can really tap into the customer's needs, understand the language that they're speaking, really get to the nub of the reason why they're buying the product. It's not just to cover a risk. There's many reasons other than that, as I hopefully have explained, and then can produce that distribution. So, I put the kind of the headlines on the left-hand side there, and I don't want to read them out, but it is really, I'm looking for the absolute market-leading experts out there, and then, I will trust them to do what they do, trust them to use the capacity properly, and to deliver the products to the customers. And we found many, and we're always on the lookout for more. And I think, like every other insurer, specialty is a growing area for AXA. We're very keen to get bigger in this space, just as other insurers are, because it does have different triggers to property insurance and liability insurance, and so we get to sell more products to our customers that aren't aligned to those losses, and it gets to service their needs even more deeply. So I think increasingly, I think we can lead with specialty. So if you write the specialty, you can then pick up the P&C and the motor and all those other bits and pieces. But being able to answer the specific needs that the customer has is probably more important than being able to answer the generic ones. Because everybody can write a property policy, yeah. Not everybody can do the specific, 12-year latent defects product that they need to satisfy a housing association. That becomes more difficult. So yes, that's what I think is necessary and needed. And there are some great specialist people out there, and I'm sure many are on this call as well. Okay, Sam, I think the last slide is the thank you. I appreciate you all speaking. I'm getting a bit of a sore throat here, so I'm going to have some water. But hopefully I used up a decent amount of the time that everybody's on the call, and I hope it wasn't too dull for everyone. Thank you for listening.
Phil, for a couple of seconds to give you a chance to wet your whistle, because we have, I'm very glad to say, got a few questions which have come into the chat, at least one of which I think is probably more for me to cover, but there's a couple here which I'm going to pose to you, if I may be so bold. So Bernice Woolley says, are these specialty products off the shelf, or could they be adapted to the opportunity? Maybe a mix and match of property and legal liability for green tech. Also, are you attending BIBA on 13th and 14th of May? So before I throw to Lee, I will say, as luck would have it, both Lee and myself are indeed at BIBA on the 13th and 14th. We'll be on the stand certainly all day on the 13th and probably most of the day on the 14th. So by all means, stop by, say hello, and have a chat, and we'll be very glad to see you. In terms of the question around off-the-shelf products, Lee, do you want to take that? And then I may or may not build, depending on whether or not I feel that you've covered everything from a distribution aspect as well.
Yeah, it's a really good question, Bernice. Absolutely. Sometimes at some points in my career I've been called the king of cross-sell. Okay, I'm always on about saying, why are we selling one product at a time to customers? Let's think about what the customer needs in the round, and let's do it all in one go. Let's make it easy for them. Let's think about the customer needs, rather than saying, oh, we'll do your property but we won't do your liability. That doesn't make any sense to me. If it's a good customer, I want to round out the proposition and cover everything that they need in one stop, if I absolutely possibly can. So, yeah, what you say there, Bernice, can we bespoke for the particular needs? Absolutely. I think it's very important to do so. These products, that we cannot kind of lever the customers into them. They have to work for the customers. It has to be that way round. Very much customer first.
Yeah, I mean, you pretty much covered what I was going to say, Lee, as well, insofar as that this is a kind of customer-centric area, generally speaking. It is specialty by design. There has to be a need there, and we want to try and make sure that the products are entirely appropriate and relevant for the audience that they're actually going to be serving. So bespoking to a greater or lesser degree is something which happens in pretty much all of our specialty propositions. Fabulous. Next question is from Simon McGill, who it sounds like may be familiar to you, Lee. I'll read it verbatim. Lee, good to hear your fellow West Country accent again. Within the worlds of defective title, IBG, latent defect, how are AXA and others addressing the challenges on exposures 25 years plus, often lifetime exposures, specifically by way of reinsurance, primary insurer costs and data for an area of such unknown unknowns? All the best, Simon.
Thanks, Simon. Cheers, mate. I appreciate that. That's a really good question, and it definitely is a a challenge. I think it is very important that you kind of think about the longevity of the insurer that's involved in these. It might sound a bit like blowing the trumpet of AXA, but these are not products to buy from insurers that don't you might not be around in 10 years time. I think that to be able to be confident, to be able to provide an indemnity period like that, it takes quite a lot of financial wherewithal, and so thankfully there are some very, very large insurance companies in this world that we do know that are going to be around for decades, and so these are insurable situations. Obviously, we have to work with the actuaries, we have to work with our finance teams, we have to work with our claims departments to make sure that everybody understands what's being asked of us here, because we are stepping up to quite a promise to be able to be here to do these, to take on these situations. We have to have deep pockets, but we also have to have great resources, and we have to have long memories. Because claims will come out of the woodwork in the future times, in future decades. So yeah, it's definitely an important wrinkle on all of this. The longevity of the promise that we're making is properly lived up to, and it's not something that we do lightly, and I don't think it's something that any specialty insurer should ever do lightly.
Absolutely. Thank you very much, Lee. And as I said, Simon, a very good question. It's alongside things like the actual accounting for it and measurement of that the performance and so on is things that we've had to come to terms with and get comfortable with in recent years. And it, as Lee says, it really isn't very simple. But if we are confident in some of those factors that Lee's mentioning, then we can get comfortable with it, and that is arguably because we are in an enviable position of being in, associated with a very, very large company. So that's good stuff. One from Kyle Lomas. Hello, Kyle. Kyle asks, Lee, do you see ATE ever becoming an extension to an MLP product and offered to customers when there is a live claim under the MLP?
Good question. Right. Hi, Kyle. That sounds
quite
like
meta, isn't it?
I was trying to think whether there's situations where that is the case, actually, because legal expenses, it is covered by management liability. So, if there is an indemnity triggered under the management liability policy, and we fail to successfully defend our insured, yes, we will pay the cost of the other side in taking on that or making that claim. The same, I would say, in professional indemnity insurance. We defend our customer. We pay our defence costs. If we fail to defend them, if the court finds in favour of the claimant, then we will pay not just the damages, but we'll pay the other side's cost as well. So that may feel like after the event, but that is kind of built into the product already. Where it would be an extension is if the management liability policy did not have an insuring clause triggered and actually acted like a legal expenses policy to cover a response to litigation. That might be more difficult. There are legal expenses rules around different insurance companies and different claims departments to avoid conflicts of interest. So we'd have to take that into consideration. But yeah, interesting thought, Carl. If you've got any particular ideas there, or you think it would be useful for particular customer bases, then would certainly like to talk. Always keen to try some innovation.
Excellent. Thank you, Lee, and thank you very much, Kyle. You can probably take a brief break for a moment, Lee, because I think this one is probably more my area. So Ollie Evans, hello, Ollie, good to hear from you, has asked, with so many insurers and specialty providers competing for delegated authority partnerships, what does AXA actually do differently? Whether that's appetite, speed, support, or something else that makes the difference when an MGA or broker is choosing their capacity provider? It's a very, very good question, especially pertinent probably at the moment when there are more and more capacity providers entering the market. I would say the capacity providers and insurers that are in the market at the moment, there's probably a broader spectrum of styles and approaches than ever before. I think probably what I would lean into firstly and probably foremost with AXA is, as the name suggests, AXA Delegated Authority Partnerships. We are a ring-fenced specific division of the company who exclusively deals with delegated authority partnerships in their various forms. This means that our entire underwriting population, our relationship managers, we have siloed claims teams and so on and so forth, all of those people who deal exclusively with delegated authority relationships day in, day out. So they understand the dynamics, they understand what is necessary, they understand what good looks like. Within our book, we have very, very large kind of high volume, low premium, commoditized digital plays. We have full scale MGAs and we have individual kind of provincial schemes, and we actually have a huge amount of experience and expertise in handling each one of those, which it has allowed us to forge our way, one would hope anyway, to the kind of the head of the pack. And I can say that with some degree of backup, given that we've won the Broker Choice Insurer Schemes Insurer of the Year award 3 years on the spin. So it's not just bluster on my behalf. We do also have the ability to kind of tailor our approach very, very carefully to the requirements of our potential partners, and over the recent years in particular, we've found our footing, and I think we found our stride in such a way that, I mean, we have a dedicated implementation team as well who do extraordinary work for us, and the speed and accuracy and how smooth they're able to deploy incredibly complex arrangements is remarkable. And has allowed us to continue to grow to the level that we are today. So yeah, I hope that gives a bit of an idea. If there's any specifics anybody wants to know about how we approach certain things, by all means reach out. I've put my email in the chat, so if anybody's got any other further questions, please feel free to aim them at me. Excellent. We have a question from Laura Berry from Polo. Hello, Laura. Probably falls between the two of us, this one, Lee. What would give you enough comfort to consider a completely new product, which as such won't have a track record? How would you assess and approach opportunities like this? Do you want to take that, Lee, or shall I?
I'm happy to start off from an underwriting perspective, Sam. I think it's really good, Laura, and we're in the risk business, right? We're not going to know for certain whether everything's going to work or be profitable. I guess as an underwriter, I'm always one to kind of look at what the worst situation could be. What's the worst downside? Can I afford that if it happens? And then weigh that up against the benefit of trying to do something. That the less evidence I have, or the less history I have, the more I'm probably going to want to keep my bet affordable, and less likely to break or to cost a huge amount of money. The more likely I am to test and dip my toe into it. Perhaps target a very particular kind of customer who I have confidence in. So you don't always need the full track record. If something is brand new, you can try it out. You can kind of consider it within the wider portfolio. It's riskier, but often it pays off more because there's obviously a lot less competition for something that you've created yourself. So yeah, it's a really good question, and it is doable, but we do so with a little bit more trepidation, and therefore we probably take a bit more care.
Yeah, I suppose probably just to build in a couple of areas, then it will be tends to be reliant on there being a very, very robust and demonstrable business plan, you know, based ideally on data and MI that we're able to kind of verify, so we can understand that there definitely is a market here, and you know, whether or not it's going to be a product which we are going to have to also invest in the development of as well. You know, we tread carefully in these spaces, but we do also like to try and innovate. It's always nice to try and get on at the ground floor if we think that there is a great idea and that it's going to serve customers well. That's something which I you know, I can speak for Lee as well, that I think we both quite enjoy and we find quite exciting. You know, we also are alive to the fact that sometimes you have to kiss a few frogs, you know, before you come along that diamond in the rough. And so we do a you know, a bit of test and learn. It does, however, as Lee suggested, it does tend to hinge on as much kind of due diligence around it as you possibly can do on something which is effectively a blank canvas. But if you've got ideas, and if you've got, you know, people who have specialties, or people who have an idea that they want to bring to us, and you want to have a discussion about, Laura, then by all means reach out. You know where we are. We're always happy to talk.
I'm a bit worried about you though, Sam. I mean, if you're going to be kissing frogs hoping to find diamonds, and you might want to sort out your metaphors.
Rather mixing my metaphors there, wasn't I? But thanks for pulling me up on it, Lee.
You know me, mate. Never let one go by.
True enough. Hello again, Manveen. I think that we're probably heading towards the end of our time. Am I right?
Yeah, we're literally fast approaching 2 o'clock. It's absolutely flown by, but I can see we've also got to the end of questions, so I'm not interrupting, hopefully, any dialogue. If anyone does have a final question, we've got just over a minute left. So I'll hang on just in case anything does pop through, and if anyone wants to just raise their hand and get their last question in, more than welcome to. But I can see lots of people are saying thank you, so I think we'll take that as a sign of a job well done. And then all that's left for me to ask is if those that attended, if they can spare a few minutes to provide feedback as always, and to thank everyone for coming, both to Sam and Lee for giving up their time to talk to you, and also for those that have joined us giving up their lunch break to come and listen. So thank you all. Otherwise, if there's nothing left, we'll wrap up there, and I'll leave you to all enjoy the rest of your day.
Thank you very much, everybody, for your time.
Fantastic.
Bye-bye.
Thank you all.